Good day, everybody, and thanks for joining us today on Prescient on Point Live. Today, I'm joined by Reza, our head of bonds, and obviously, we're going to cover everything related to the bond market, and in particular, the funds that Prescient Investment Management has covering the bond space. Reza, thanks for doing this with me today.
Absolute pleasure.
It's always good to have a conversation about a highly topical asset class at the moment. Given global geopolitics and what's going on, let's start with the US 10-year,
Yes,
once referred to as the center of the investment universe.
sure.
That has a massive impact on global bond yields, and particularly South Africa, which we'll get to next. So we've seen bond yields in the US rise again,
Yes,
on the back of obviously what's going on in the world. Maybe just give us a sense of where you see that
yes.
and how things have played out in the recent past.
Sure. Thanks, Marie. Yeah, I think a good place to start, and I mean we'll get to this juxtaposition, I suppose, a little bit later on, where we look how the bond market in South Africa, in contradistinction to what has happened to the US, has digested the geopolitical turmoil in the Middle East. So if we look at the US, per your question, you see that the dislocation primarily sits not on the inflation compensation side. It's really on the real yield side, right?
Mm,
So in South Africa, the reverse is the case, but I'm sure we'll get there.
mm,
So
mm.
real yields have really risen to sort of multi-decade highs in the US. Now, what are the reasons for that? The key reason for that is that the inflationary component is actually very, very well behaved.
Mm,
So despite that, the fact that you have sort of this exogenous supply side event in the form of higher oil prices,
mm,
that has been fully looked through in US yields. What has happened, in fact, is that if we look at a sort of a disaggregation of that US 10-year yield, what it's really saying is that the path of real yields the average path of real yields will need to be kept almost, as the proverbial saying goes, higher for longer,
mhm.
but that this may coincide with a time of slowing consumption. So
Okay.
because you're going to have a time of higher real yields and slowing consumption at the same time, those are two sort of bad states of the world. The real term premium needs to increase to basically take into account
Yeah.
for this. So all the action in the US 10-year is sitting on the real yield side.
Mm,
Now, why this is consequential is because in order for this almost like to correct itself, these are two notoriously slow-moving components of the US 10-year yield, right? So the real components are notoriously slow-moving, and the time to which it actually can revert to more equilibrium levels can be quite long,
yeah. Yeah.
and they depend on the reaction function of the Fed. So the US is quite a complicated case.
Sure.
There's a lot of fat baked in there, but in order for that fat or value to be realized, it'll depend on a lot more levers than what is a simpler case in South Africa.
So what's interesting is the US equity market,
Yes,
in the face of rising yields, still continues to chug upwards
y-
for
yes,
understood reasons, but
yes.
that's not normally what you see in the market.
Absolutely. So a lot about that is, as you'd know, uh, it's a very narrow expansion in the U.S. equity market, and it's been driven largely on the back of the prospects for AI and the sentiment
Sure.
around that, right? So remember, many of these, businesses do not have hard, tangible earnings as yet,
Mm.
but what the market is, of course, factoring in
They're coming
is the
eventually,
idea
I
it
hope.
will come eventually, and you have this J curve that somewhere over the rainbow there will be actually
Yeah,
real cash flows and things, which
sure.
might happen, but also there's the real risk that it basically overshoots, and and
Mm.
and, and this is sort of a sentiment driven bubble that may deflate at any point.
Yeah. Okay. Let's bring that to the South African context. So we don't operate in isolation. So
Yes,
obviously the SARB's got to factor all of this in.
yes,
We've seen some decent numbers on the fiscal side. We've seen inflation rising. We had a 25 bip increase recently.
yes,
South African bond yields have been a little bit elevated as a
yes,
consequence of all of this.
yes.
Give us your view on the SA situation.
Right. So the SA situation, in contradistinction to the US case, has been purely, I would say, excess pessimism that has been baked into the break-even component. In other words, the parts of a bond deal that relate to inflation compensation. So let's unpack the ABCs of how an actual oil price spike works, right? So the proximate issue is geopolitical turmoil in the Middle East, and
Hmm.
so you have Brent going from, let's say,
Hmm.
mid 60s to mid 80s. So that's a 40% increase.
Yeah.
Okay. Now, when oil prices spike, that is referred to as an exogenous or shock that comes from the outside and has its origin on the supply side. Okay. So higher oil prices, this is not common knowledge, but higher oil prices are actually disinflationary in the medium term. Why do I say that? Is because what actually happens is higher oil prices acts as a tax on consumption.
Sure.
So you're spending more on energy costs means that you're
Got to
spending
change your
less
behavior elsewhere.
somewhere else, right? So generally, higher oil prices leads to lower aggregate demand, which then begets lower oil prices. So supply side shocks are inherently self-correcting.
Okay.
So the ideal textbook way in which a central bank should navigate its response function is that it should actually look through
Sure.
exogenous supply side shocks, except if there's a danger that the expectations that this inflation will not be a short-lived bump, it will be a lot longer, right? Now, there's no evidence that that is actually
Yeah.
happening in surveyed measures of inflation here in South Africa or in other market-traded measures. There's no evidence that second-round effects are actually taking place, however. However, the SARB has almost opted or erred on the side of caution and
And
is almost saying, let me preemptively
into
act.
sure.
Uh, I should really look through this, but let me preemptively act and let me make sure that those inflationary expectations get kept in kilter. So preemptive, I think if you look at the evolution of the FRA curve and what's been priced in, I think that it is, in a manner of speaking, excessive
Mm-hmm.
relative to what needs to be the case. But I do think that they've clearly, via their communication, and what is obviously behind this reaction function is the expectations component.
Okay. That volatility, if we call it that, creates opportunity in the bond market
Yes,
for us, and particularly in the two funds mentioned, the Prescient Flexible Bond Fund, and then also our Prescient Portable Alpha
yes.
Bond Fund.
Mm.
Just tell us how the opportunities have played out. The Flexible Bond Fund is the best of cash and bonds, and so
Yes,
opportunity to express your views
yes,
in that fund.
yes,
And then for those clients that want to have a all be benchmark type fund with some outperformance. So
yes,
just talk to those two
yes.
opportunities and how you've been active in the bond space,
Yeah.
particularly.
So they almost, the flexible bond fund and portable alpha bond fund almost speaks to two diametrically different client bases, if you will, right?
Okay,
So
yeah,
the flexible bond fund is a high conviction, non-duration constrained, non-sector constrained, almost best ideas proposition. So the idea of flexible bonds is to say that the portfolio manager can really be anywhere on the yield curve, anywhere that he sees value, and he'll position himself in a way that is quite agnostic of the Allby, right? So from time to time, that means that on a look-through basis, the flexible bond fund could look like an income fund, right?
sure,
And at other times, a very highly convex, back-end heavy bond solution, right? But in both cases, they need not, the fund does not really pay attention to tracking error constraints
okay,
or being very benchmark centric. Now, some clients absolutely love the prospect of that kind of flexibility, but there's a very real prospect here of that that kind of dislocation from the Allby being very unpalatable, right?
sure,
And it was exactly in the wake of that kind of an unpalatability that we had the portable bond fund, coming to the fore. So what is this? It's really a solution for all the critiques of flexible bond, right?
sure,
So in other words, if clients now want a bond fund that is a very much more low tracking error, very much more benchmark centric, but that doesn't have the negative ramifications of a pure passive solution. And we
sure,
know what that means. If you,
sure,
if you go a purely passive solution, you will mechanically underperform the index by the quantum of your management fees.
yeah,
So I want low tracking error. I want an Orbi-centric solution, but I also want outperformance. We have the solution for that.
good, yeah,
That is Portable
okay,
Alpha. So both funds have done quite well since its inception. Obviously, the
mm-hmm.
Portable Alpha has got a smaller track record, but impressive nonetheless. And Flexible Bonds has taken the necessary latitudes which it's had to take advantage in the dislocation that we spoke about a little bit earlier on in the break
Okay,
evens, and so it's positioned in a highly convex way. The Portable Alpha gets its alpha from a different engine.
okay. So I'll put it in my words, two propositions.
Yes,
Portable Alpha Bond is really for an allocator saying, I want all the exposure
yes,
given my strategic or tactical asset allocation,
absolutely.
but I want better than Orbi performance with some overlay, and
Yeah,
that's a portable alpha strategy
absolutely.
and at a reasonable price.
Yes,
The flexible bond fund is saying, I want to outsource a duration mandate to you. At times, I want you to be long duration or short duration, and I'll leave it up to you.
Exactly
And
right.
therefore, your tracking error is acceptable.
Exactly.
Whereas your allocator might be saying, I don't want tracking error, but I want better than Orbi. So
Absolutely.
two beautiful solutions for those two outcomes required.
Dead right.
And as we've said, highly topical, exciting times for the bond market because of all of the stuff going on.
Yes.
And maybe just last comment then is, where do you see value in the SA bond curve at the moment?
So remember what's actually happened here, Murray, is that if you think about the 40% jump in oil prices that we've seen, right? Now, as we've explained, what that happens is that it's very plausible that in the next 3, 4, or 5 months of the inflation process, that has a knock-on effect. It's particularly in terms of the energy-centric baskets like transport. That has a very measurable and very plausible uptick in inflation. Okay, but is it correct to assume that I will see this kind of 40% jump in oil prices every year?
Yeah.
Will there be a geopolitical event every year for the next 10 years?
Mm.
Unlikely, but that is exactly what's been priced into the 10-year break
Okay.
even. What's been priced in is that this will be an ongoing shock that you will see
No.
every year for the next 10 years,
Mm.
which is obviously very probabilistically unlikely.
Sure.
So we want to take advantage of that dislocation. So, but the ride along which you need to travel for break evens to compress can be a bit bumpy. We see this kind of up
Sure.
down negative serial correlation market every day, one day up, one day
Mm.
down. So that bumpiness of the ride can have ramifications for taking advantage of this in an income centric solution. So that needs to be said. But if you've got the runway, right, and you can
Understood.
tolerate some volatility, then we think that there's a lot of value to be had by taking a long duration position on the back
Yeah.
of these break evens, which we think have baked in and
Yeah.
extrapolated what will be the recent inflation experience for the next 10 years, right,
Okay.
which we think is
Great.
excessive.
So good opportunity to enter local bonds for a
Absolutely.
bond fund at this stage. Okay,
Absolutely.
great.
Absolutely.
Reza, before we end, I always like to ask the question around something about yourself, a little bit of interest
Yes.
outside of toiling in
The bond market.
the quant world of
Yes,
bonds.
yes,
Tell us a little about yourself
yes.
from an interest perspective
From
outside of work.
yes, so it would be now quite an interesting twist if my interests were, well, let's say less nerdy, but unfortunately I have to disappoint you. They're very very nerdy interests. Murray, I'm something of a compulsive reader, with very wide ranging reading interests.
Okay.
That spans from the minutiae of details around the Second World War, to books about mathematical logic, to books about unpacking the financial crisis. So there's a range of things, right? So
Okay.
uh,
What's on the reading? What's on your bookshelf or next to your bedside table right
s-
now?
so there's an interesting three-part series by an author called Hilary Mantel, who writes a book called Wolf Hall, and it deals with a period in Tudor history, about Thomas Cromwell and
Okay.
all his machinations with and against Henry VIII. So that is
Wow,
very
that's
very
very
interesting, and
interesting.
that particular period in English history shaped England's breakaway from the Catholic Church as we know, and also shaped what modern English society is today. So that's
Very
currently on
interesting.
the
That
bedside table. But like I say, very nerdy interests. Unfortunately, I have to disappoint.
that's
It's not something very
no, but
racy
interesting
or
enough.
exciting, but quite
Yeah.
dry, like my personality.
Reza,
Yeah,
the bond market will keep you sane,
sure. Yeah, yeah,
eh?
definitely.
Listen, thanks very much for doing this.
Sure.
Always good to chat. And to those that have dialed in and listened to us, thanks very much for joining.